Everybody. My name is Kola Ashiru Balogun. I'm the Managing Director of Mixta Real Estate PLC. We're just going to wait like 1 or 2 more minutes just for everyone else to join the call. And then we'll start this immediately.
Yes, good morning.
Thank you, sir. All right, good morning once again. Thank you all for joining this webinar session titled Making Informed Investment Decisions in the COVID-19 Era. We're looking at this purely from a real estate perspective. This morning we have a group of panelists that are on the call that will be providing guidance in terms of the types of decisions that we would make over the next few months as we go through this I'll just go through kind of like a welcome address to set guidance or to set the stage and the ball rolling for the event. After which we would get a presentation from my colleagues at the ARM on the economy as a whole. Then after that, we would go through the panel discussions. Late last year, and if you don't mind, at some point I might have to disable my video because of late last year, I got my budget for 2020 approved by my board, which clearly defined my strategies for tackling the upcoming challenges in 2020. Never did I know or could I imagine that a single event, which we failed to pay attention to, would cause such a structural disruption to the global economy. It has only been a few months into 2020, even though we all just wish the year was over. But I think it's important to recap what has happened so far this year. In ending February this year, we had just gotten over the extended Valentine promo period, which seemed much more exaggerated this year because of a very slow and dull January. We all argued that a devaluation of the Naira was likely, but could not agree on when. The CBN governor tried his best to give investors confidence that the devaluation was very unlikely. Most of us did not agree with him. He said that for as long as reserves were around $38 billion and oil was trading at above $50 per barrel, we would have sufficient firepower to fight devaluation. Oil as of yesterday traded around $21 per barrel, and our reserves have since dropped to about 35 billion as of the end of March. The Naira, as we all know, has since been devalued to about 380 to a dollar. And the question is, would there be another round yet again? The central bank also decided to take advantage to challenge the high interest rates by cutting rates early in January. For years, most investors had sought investment shelter in treasury bills, which were yielding over 13% per annum. This changed overnight. Suddenly, banks once again started lending aggressively. We all received messages, notes, and alerts from banks asking us to take salary advances and different type of loan instruments. All of a sudden, real estate became more attractive as rental yields, which have historically been below treasury rates, were of interest to investors. For those of us that were active in the capital markets, we bit our fingers as we saw rates drop to levels we couldn't have imagined late last year. Some of us took advantage of the market and issued commercial papers at almost 9% lower than what we were used to. Sales instantly picked up, and I was confident that my company would surpass its Q1 projections. I was looking forward to the board meeting for the first time, and this was until the COVID-19 hit us in early March. That virus that we had thought that would never affect Blacks or Africans was now in Lagos. Things have since changed to levels we could have never imagined since then. We're working from home now. We're having a Zoom webinar. These are things that I could have never imagined months or some few months ago. So what would the next few months be like? What would property prices drop? Are we in a recession? Is it a good time to invest? When will the economy recover? What will the government do? What can the government do? These are some of the questions we've received from our retail and institutional clients over the past 1 or 2 months. From our perspective, we believe real estate is a cyclical investment that in the long run would pan out better than equity and other investment instruments. But we thought it's better to put together a panel of experts that can share their experiences and bring light to this. Certainly, there's going to be a new normal post this crisis that will be filled with new opportunities. And it's important that we all learn from experts on how to position ourselves to gain the best from these opportunities. To kickstart this session today, we thought like I mentioned before, we thought it would be ideal for our research team at ARM. ARM owns Mixed Africa, and we want them to share their insights into the economy. Afterwards, we'll go through a series of questions with the panelists, and then we can take some Q&As from the audience before I come back to wrap up. Just some home rules. We've disabled the audio and video features for this webinar so that we can minimize disruptions. We ask participants to please use the Q&A buttons at the bottom or the left side of their screens, depending on the system they're using. Some of our panelists may also disable their videos as we go along to minimize any connection issues. So let's start. My colleague, Olamide from ARM, will take us through our presentation on the economy.
All right, thank you, Kola. Good morning once again. My name is Olamide, and I'll just quickly give you the view on what we expect for the economy, key macros, as well as what our market outlook will be going forward. Starting with the crude oil markets, we've seen a lot of volatility in the markets. US crude actually went below $20 per barrel. It went below zero. Our Brent went below $20 per barrel some days back. It's come back again to $21 per barrel. And it's basically just been an issue of demand. There's no demand. A lot of factories are closed. Those that are producing, they're unable to get buyers, to pick up some of the crude that is available in the markets. Even with the OPEC cut that has happened so far, it's not sufficient. So it's not a case of supply now, it's a case of demand. Nobody's demanding for this crude because there is no production happening. And hence the reason why we've seen that volatility in the markets. For average for Q1, we did about $50 per barrel. What we think will happen over the rest of the year is like we've seen so far, reports on vaccine, it looks more like nothing is going to happen as far as the vaccine is concerned this year. The prospect is for us to have a vaccine by next year, but for most economists, they think that most analysts have come out and said that they think the coronavirus, the pandemic will remain. You probably just have situations where you try to manage things like social distancing to manage the situation, or we don't expect a vaccine to be released this year. And in light of that, it means that you will not see economic activities remain the way it used to be. And what that means is global demand will still be threatened, and just tells you the direction for crude oil prices. So we think crude oil prices will remain low all through this year. In terms of what we expect for our GDP, we did 2.3% in 2019. Over Q1, they've not released the numbers. So for January and February, things would have still been good. The lockdown started as at end of March, and a lot of things started slowing down from March. So We think Q1 you might still record a positive growth, but from Q2 you definitely start to see, a contraction in growth, and it will come from both your oil sector. So we've seen a lot of reports show that the government is struggling to actually sell its products. At some point, they had to start selling at a discount, in order to be able to dispose what they have at the moment. Also, recent discussion by the NNPC MD has come out to say that based on the issues they're having with selling, there might be a halt to production in going forward. But right now, they're still doing everything they can to make sure they're selling. It's just to tell you how the country is actually struggling, based on this global pandemic. And the way the economy works, our key product is oil. So you would definitely expect the fact that we're not going to get enough receipts to filter into the non-oil sector. So you can expect key slowdown, across various non-oil sector. Agri, a lot of these northerners, the virus has actually also moved there. And you might actually, so instead of just having a lockdown in just Lagos, Abuja, and Ogun, you might see it actually, extend beyond these three states because it's spreading, rapidly. And what that means is people won't be able to, produce like they were producing before, and then you can expect a contraction. The best case scenario is that we have a contraction for Q2 and Q3, and then things come back up in Q4. But it's most likely what we think would happen this year. Most likely, there's a tendency for us to still contract in Q4, being that it takes us a longer time for us to come out of a contraction in growth and all. And we think that you could actually see the prospects, there's a higher prospect of a recession this year. On a fiscal deficit, the case is very clear. I already said that we're struggling in terms of production of, in terms of selling what we produce, that's the crude oil, as well as the prices are also extremely low. So that tells you that our key source of revenue into the country is extremely low at the moment, and the expenditure remains sticky in that the recurrent expenditure, which accounts for the large chunk of what the FG's expenses is not going down. You have to pay some of your obligations, you have to pay salaries. They might decide they won't pay some and they will pay some, but the fact remains that your recurrent expenditure is still very high. We don't think they will be able to do any capital expenditure based on what is going on right now. And what all of this just tells us is their fiscal deficit would definitely be larger than what they projected. They're projecting around 2 trillion, in terms of the deficit, but you can be sure that that would definitely be higher, for 2020. Going on to currency, it's still clear that they already did a technical devaluation based on the fact that they are struggling to portfolio flows. If you try to look at the data, portfolio flows into the country has slowed significantly. It has contracted. You're not getting interest in the country just due to the fact that our reserves are extremely low at the moment, as well as the source of income or the source of revenue into those reserves is actually drying up, and there's a tendency that our expectation right now is our reserves will actually go below the $30 billion that the CBN has said they were comfortable with. So which just tells you that the risk to currency is very high at the moment. It depends on how long this pandemic goes on, but there's a very high probability that if it goes on for for the next 6-9 months, you could see another devaluation in the naira. For inflation, inflation for the first quarter, it's on the average for the last number that they released, it went up to 12.26. So on the average, you have between 11 and 12 for Q1. And what we think will happen for full year is inflation will definitely be higher relative to 2019. 2019, it printed at average of 11.4% was what we did in 2019. But right now, there's people able to ask some of the product or the food produce they were able to get before. So there's been an try to reduce petrol price as well as delay the increase in tariff. But we think the other things that have happened, which is the devaluation in naira, as well as the artificial increase in food prices, will definitely still drive inflation higher for this year. So we're looking at inflation going close to about 13%, for 2020, based on the dynamics that we've seen so far. In terms of monetary policy rates, what we've seen is it's literally been flat. It's become just a figurehead so far. They try as much as possible not to move it. And then what we think will happen this year is they would definitely, the downside to where the rate is very low. What you will see is best case is they will leave it at where it is, just because the FX concerns. Like I said earlier on, portfolio investors or foreign portfolio investors are not bringing money into the country, which is one of, you cannot take low because you don't want to discourage them entirely. So you have to either leave it stable or increase it. Increasing it will mean that it will be counterproductive, being that the economy is already struggling. You're already stifling the banks worse. So that just tells you that really remain low. Moving on to the next slide. So we'll be talking about our market expectations, what we think will happen for key markets over 2020. For equity markets, we've seen the downturn where the market has significantly lost over this last month. In March, the market dropped significantly, and that's due to the risk of where a lot of foreign investors have been selling off their assets. If you look at US, a lot of investors are going to the safe haven assets, which is the dollar investments, the USFG, the treasuries. That's what you're finding investors going into. So we've seen a lot of sell-off. The fact that there's weak economic outlook, like I said, there's a very high possibility that the economy actually, goes into a recession this year. There's also the concern of lower crude oil prices, threat to production, as well as a further currency devaluation. So that just tells you that we see the equity market, going down this year. But however, for us, we still believe that the market going down, it literally just presents, some sort of opportunity. If you have like a long-term capital, not the short-term, because a lot of the stocks are trading really low at the moment. But by and large, equities market performance will be very low. It will be down this year. For fixed income markets, there are a lot of moving parts to it. So like I said, the deficit is going to be way higher than the projected. They are looking at getting some funds from, they're looking at getting some multilateral loans just to help survive during this period. But even at that, we think the deficits we're looking at a deficit of about 4 trillion naira. And what that means is even if they get the facility from this multilateral loan, right now they still need approval, which means that there's some sort of delay. They need to meet their expenses over Q2, which they've not been able to. The bond auction that happened yesterday, they literally had to take, higher than they said they were going to borrow. And that tells you that the government is actually pressed to borrow more funds. Getting the multilateral loan can help them in terms of not increasing rates. But the best is we don't think you will see rates really go low from where they are right now. You'll probably see it at similar levels, except they get more support funds that might be able to help. But in terms of rates going way lower than where they are right now, we don't see that happening. With the major dynamic being the fact that they have this large deficit, which is going to definitely exceed what they had planned before. For the real estate segment, it's been contracting for a while. The contraction has actually slowed. As of 2019, we saw the contraction actually slow down when we felt before the coronavirus pandemic happened. We felt we could actually see, some positive sentiment from that this year. But based on what has happened so far, we think you will find a slowdown in investment, from both the FG as well as the private sector, because consumer income will definitely be pressed this period. Then onto the triggers, what we think will be the triggers for 2020 that could cause, having given our outlook for key for the markets, what we think could be a trigger for the economy for this year is if we get the multilateral assistance, like I mentioned, we're expecting to get about $6.9 billion. We're yet to get the approval of that, so that could help with the reserves. Also, if the pandemic ends and prices go higher, crude oil prices go higher from where they are, then yes, you could see the whole outlook we've given concerning the market. You could see that actually retrace. For the equity markets is also clear. Increased economic activity would mean that you would see people, come back for equities. Higher crude oil prices too would help with that. For the fixed income, they already revised the crude oil price to about $30. The benchmark now is about $30. It's already about $30, but an increase in crude oil prices means that, so I already said that the deficit was going to expand, but in a case whereby crude oil prices actually go higher, it means they'll be in a better position. I would not have to borrow. So that could, change the outlook for most of the markets. But right now, from the look of things, from where we stand, it seems most markets would actually be down, this year. Now we move on to the next slide. What we think you should be doing, there's a lot of uncertainty going on. There's a lot of jittery movement. You're not sure what to do. Should you hold cash? Should you invest in real estate? Should you invest in equities? Should you go ahead to fixed income? And we think there are key things, there are essential things you should be looking at if you're going to, before you make your decision on investment, on whatever investment you're going to pick. You should know that in this period, you need to be very strategic. You need to be focused on your long-term goal, and there needs to be some sort of discipline to what you're trying to achieve. So rather than reacting, based on what you can see, it would be good to be proactive in that. How do I prepare myself for? So the economy is down at the moment. What should I be doing? Where should I put my money? And then how do I prepare myself, to be in a better position once this thing starts to die down? And we think the essential things, the essential questions and things you should be looking at is your risk tolerance. That would help to determine the kind of investment you should be looking at. Your liquidity needs too. So if you have immediate cash liquidity needs, if you have liabilities that you need to pay off, things like school fees, things like health needs that you need to meet up in short term, and there are things you need to consider. And if you do not have immediate liquidity needs, if you still have long-term capital, it will tell you the kind of investment you should be looking at. And also, your investment objective is key. What are you trying to achieve in the long term? Where exactly what kind of capital do you want to have at the end of the day? And if you're able to tell that, then you can tell the kind of investment class you should be putting your money in, despite all of the things we expect for this year. Your asset liability match is also very key. You state out the expenses you have over the next 1 or 2 years, as well as your assets. We already know we need to have higher assets than our liabilities. So if you're not going to even have higher assets than your liability, there needs to be a match, such that you're able to meet whatever liability that will come on board. So we think these are like the key essentials that you need to ask yourselves in this period before making any investment decision, so as to be in a very appropriate position once this pandemic is over, or to ensure that while it's still going on, you're properly placed, to maximize the opportunities that are presenting themselves in this market at this moment. Thank you very, very much. I would hand over to Kola.
Olamide, thank you very much for a very detailed presentation. I'm not sure if we all agree that it's kind of like a gloomy outlook. I need clarity, and these are part of the discussions we would have. We need clarity on whether it's a recession. You said the equity markets are more or less going to continue going downwards. Devaluation is of key concern. Is it going to happen again? Rates wouldn't change. They're not going to go lower than what they are right now. So these are very interesting. These are very interesting times for everybody. I think we can move over to our panelists today. Again, we thank I think we have over 400 participants that have joined us today. We thank you all for joining. If you have questions, 300 participants. If you have questions, we advise that you should please just send in your questions, type in your questions through the Q&A box. Today, we have a very exciting set of individuals that will be walking us through this session. The first person is architect Ahmed Dangiwa. He's the Managing Director and the CEO of the Federal Mortgage Bank of Nigeria. We'll be hearing from him on his insights on what the bank plans to do post-COVID and how, if at all, this pandemic would affect their capability to continue to issue mortgages, especially through their famous product, the National Housing Fund. Dr. Temitokbe Oshikoya is the Chief Economic Strategist of Next Homes Limited. He's a seasoned economist, a policy analyst, and a chartered banker. Mr. Daudu, Jamil Daudu, is the Managing Director of CBRE Accelerate, the full-service real estate firm, and they advise clients, corporate and retail clients across Africa. Mrs. Udo Okonjo is the CEO and the Vice Chairman of Fine and Country West Africa. She's an astute real estate entrepreneur, an international lawyer, and our firm specializes in real estate investment management for HNIs and they provide several other services. Mr. Chinua Zubike is the MD, Managing Director and CEO of InfraCredit. The company provides local currency guarantees to enhance credit quality of debt instruments to finance infrastructure projects within Africa. Chinua has worked with several key initiatives on debt financing over the past few years, so it also shares insight on what to expect. Unfortunately, Mrs. Chukunonso Onieze, the CEO of Assist to Sell, is unable to join us today due to a bereavement in her family yesterday. Please let's be with her. So I'll go over to the questions. I have a couple of questions here that I will start with. Dr. Oshikoya, I'm going to start with you if you don't mind. The IMF, in its regional economic outlook for sub-Saharan Africa, projects a 3.4% contraction of the Nigerian economy this year, due to the part of the decline in commodity prices, we all know, particularly oil. What does this mean for local businesses in layman's terms? You have to unmute the mic. Can the host help unmute all the panelists' mics, please? Yes, we can hear you now, sir. Dr. Shikoya.
Yes.
We can hear you. My question to you was the IMF, just to repeat my question, the IMF, again, in its regional economic outlook for sub-Saharan Africa, projects a 3.4% contraction of the Nigerian economy this year. This is in due to the sharp decline in commodity prices, especially oil. What does this mean for local businesses in layman's terms?
Okay, thank you very much. I think you had raised an issue earlier on that are we going to be in a recession or not? Definitely, the answer is categorically yes. We are going to be in a recession. And with 3.4%, minus 3.4% that is being projected by the IMF, it basically shows that you're going to be in a recession. What is the impact of this for local businesses? First, you see that if you look at the component of GDP, as the earlier presenter made on the economy, you are going to have decrease in exports due to decrease in prices of oil and oil production, which will affect consumption, consumption per capita, which will also affect investment in terms of uncertainties affecting investment, as well as importation of raw materials for manufacturers, for example, will also be significantly affected, because if you don't have the foreign exchange, the implication is that you don't have the ability to source foreign imported raw materials. So local businesses are going to be affected through those different channels. There is going to be decrease in demand for their products. There is going to be decrease in investment. They are likely going to react by doing what? By trying to conserve capital, because they have the issue of liquidity versus insolvency. And in order to remain solvent, they probably want to preserve their capital, preserve cash. In essence, cash is king at this point in time. And as a result, it's more likely that they will probably cut down on employment, with the implication that employment is likely going to rise. And as a result, it's extremely important that, as been done in places like the Western countries, we need to come up with palliatives that will help local businesses. And when we are talking about local businesses, because we are an economy which is at least more than 50% an informal economy, it's more likely that the informal sector will be significantly affected because they essentially operate on a daily basis. They generate their cash on a daily basis. And with this lockdown, for example, it's going to be extremely difficult to be able to generate cash on a daily basis. So both the corporate and the informal sector are going to be impacted significantly because of this coronavirus, and are already being affected actually.
Thank you, sir. That's quite interesting. We all know that cash is always king. We know unemployment. We hear that unemployment would raise. It's quite concerning. I think there was a recent McKinsey report that they issued. They mentioned Africa as a whole would lose about 18 million jobs due to this pandemic, and 18 million jobs out of the 100 and something jobs in Africa as a whole. So it's something that is going to be quite severe. Olamide, again, I know Dr. Shikwaya is adamant that this is a recession. I think we're always very careful in determining whether we're in a recession or not. Other analysts define a recession as a number of negative growths and a number of quarters over a period of time. Can you answer authoritatively, are we in a recession? If not, when do you see us entering that recession? Or even worse, are we going to go into a depression?
Okay, thank you, Kola. So for Nigeria's case, the definition for a recession remains the same. It's typically 2 quarters of negative growth. But for Nigeria's situation, it's been a case of between where we're coming from and where we are at the moment. Hence the reason why there's a lot of argument to say that we are already in a recession, right? And what typically happened is between 2005, I'll just track back a bit just to give a context to why you could see a lot of analysts already, saying that Nigeria, as far as they're concerned, Nigeria is already in a recession. Between 2005 and 2010, we're recording growth of about 7 to 8%. Between the next 5 years, we went to about 5% average growth. And then, the 2015, 2016 crisis where we actually, we went into a recession, the economy contracted. But since then, we've not been able to return to where we're coming from. So on the average, we did 1.9% growth at some point. Last year, that's 2018, we did 0.8 in 2017. We went to 1.9, and then we did 2.3. So these 3 years or so after the recession, we've not been able to get back to just even the 5% level of growth. And was supposed to be the giant of Africa. And if you compare it with the other emerging countries, you find out that they are recording way better growth than the 2% we're recording. Hence the reason why you find a lot of argument to say that Nigeria is already in recession. But looking around, the definition of recession remains the same. So as to the fact if we're in recession or not, currently no. But definitely the fact that our growth is still very disappointing is the reason why anyone would want to refer to us that we're in recession. But there's a very high chance, there's a very, very high probability that we're actually going to go into recession this year, and it will now take, a longer time for us to even get out of it. Depression in its definition. So I guess I just answered the question if we're in a recession or not. currently, no, we are not in a recession, but there's a high probability we will actually go into recession this year. In terms of depression is actually, so instead of looking at quarterly contraction in growth, which is what recession looks at, the depression is actually, looking at the definition. It's looking at years of contraction, so you have contraction in economic growth for a very long period of time. Now you're not even focusing on the quarterly numbers, you're looking at the annual decline in economic activity, over a long period of time. That at that point, we are already in, that is the definition of a depression. If Nigeria will go into depression, I don't think we will. I think what you would just have is what we've done in the last few, in the last 2 years, where growth will be extremely, slow. It would be very low. It won't be as high as where we're coming from. And that's because our focus is still on the oil. We've still not looked at other parts that can help the economy. ICT, for instance.
If you don't mind me asking, how long do you think this recession would be? Just from your own guesstimate, from your own perspective, is it something that will be in this deep for, you analysts use like an L curve, U curve, V curve. Is it, how long do you think it's some few quarters, a year or 2 years or what?
Well, from what we have right now, you can be certain that for this year, we are going to be in a recession. By 2021, the tenor of the recession literally depends on the efforts the government actually takes post this pandemic. Now, if they're able to, take measures, put in policies that filter straight into the economy, filters down into, businesses that are able to grow and generate, activities for the economy as a whole, then yes, we might be out of it, say, H2 next year. That's if they are able to actually put in the right policies in place that will get us back. But if not, then you might actually see this, still continue in 2021. So US, for instance, the projection for US so far is they'll contract this year. But again, because of the kind of policies they've tried to put in place, the monies they've tried to release to help businesses, such that they are still surviving in this period. Recently, that was yesterday, they still approved another $500 billion for small businesses to be able to still thrive, pay up their obligations in this period, just to be able to help economic activities. So, that's a country that still has about $500 billion to release. And this is us that our old reserves is just 34 billion. It's less than, it's around $34 billion already. 33 to $35 billion is where we are at the moment. And that just tells you that the measures we can put in place would be very, very important to help us to actually leave the recession, quick enough. But I think the earliest we can do, say we put the right measures in place, will probably be, going into the second half of 2021.
All right, thank you. Dr. Shikoya, I assume that you agree, or do you think it's a gloomier picture than what Olamide has mentioned?
Well, I don't know about depression, but if you look, who defines a recession? Technically, it's defined by the U.S. National Bureau of Economic Research. And it's true, they used to use 2 quarters of falling GDP growth rate. But of recent, after the global financial crisis, they refined their methodology and realized that they are basically using lagging indicators. That you can be in a recession before the data comes out, before the data for GDP comes out. So in a place like the US, where, for example, you have almost about 20 million, indeed, I think this week, it's like going to have about 4.5 million people claiming unemployment, making unemployment claims. Last week, it was 5.5 million. In essence, all the jobs that were created after the global financial crisis in the US, all of them have been lost. So the NBER doesn't need to wait for 2 quarters of GDP to know that there is a recession already going on. You understand? The same thing with Nigeria. The only thing is that in Nigeria, the National Bureau of Statistics has been trying its best, but we also know that the data they provide are not as accurate as, say, what will be provided in the US. Neither are they as current as what the US will provide. So even from anecdotal evidence, you know that the country is already in a recession. If your informal sector constitutes half of your activities, economic activities, and they are completely in a lockdown, they are not in any form of productive means. So I don't need to wait for 2 quarters of GDP to know that they were in a recession. As for a depression, I think, as Olamide said, she's right. It has to be things like at least 1 year of or multi-year decline in GDP and so on. But if you look at GDP per capita instead of GDP, you know that our GDP per capita has stagnated for some time. So depending on indicators we are using, we are in a dire economic situation.
Well, that's I think that's like both allude to the same fact that yes, we're in a recession. I well agree that it's going to last at least through H2 2021, which is quite difficult. But I think this also presents a significant amount of opportunities for investors, retail and institutional investors out there. And you know, while I would like to continue the discussion on the economy, I think it's quite. I would like to go over to more real estate, which is the reason why we're here. Jamil, I'm going to be asking you this question. So we've all agreed that post the COVID, we're going to go into a recession. How do you see this affecting each of the subsectors of real estate? You know, from the commercial side to the residential side and hospitality across the board. What do you see going on?
Well, thank you, Kola. You know, your question is almost similar to the same question people asked themselves in 2005 when we had the credit crunch crisis globally. And, you know, the first question you ask is, when there's a recession, there are opportunities that exist in a recession. And that's where you talk about the two segments of the market. Now, in any form of recession, you have the opportunities, the capitalists who are the cash buyers who come into the market to buy properties that have lost or declined in value. Now, you've got to look at it in two ways. In the residential market, there'll be more opportunities there where a lot of investors can buy cheaper properties. When you now come to, when you look at it holistically, you know, like Olamide said and Dr. Shinoy also said, is you've got to look at the objectives. Why are you acquiring these properties? And what's the time frame in which you're looking to make a return on those properties? Now, for people who are buying cheaper properties, is that they're buying it for the long term. They're not looking for an immediate return, and it's a cash buy. Now, so there'll be more opportunities like that in the residential market. But when you come to the commercial market, it's a completely different game, because then the kind of money you're talking about to buy these properties are a lot more than what you'll be spending in the residential market. Now, with the commercial market, you're either coming from a pension fund, or you're coming in as a private equity buyer, and you would require, you know, debt to be able to buy these properties. And the bigger question is return. So in any recession, is that your return declines because it's a question about liquidity. And this is almost something we noticed in England in 2005, and took the United Kingdom almost about 5-6 years to come out of that recession, to be able to get to where they are today. And we're going to see that happening. Now, we saw that happening come 2016, where a lot of investments in the commercial sector had developed a lot of grade A properties, hoping to make about $1,000 per square meter on rent. And a lot of investors had to drop that 1,000 to about 750, say for example, in Ikoyi. Victoria now dropped theirs to about $650. Even with that, there was the take-up space in the market was still very slow, and we had a huge void period. Now COVID-19 has come in and has changed the whole dynamics of it. So we're going to see a further decline in rentals across board, because again, like the two panelists said, it's a question of demand. The supply is there, but the demand is going to decline, because COVID-19 now has given a lot of occupiers different ways of how they can carry on their business. If somebody had told us 2-3 years ago that a time will come when Nigeria will be doing everything online, having virtual meetings and people working from home, we will all say, no, that's impossible. We don't have the infrastructure. But here we are, we're all doing that. So come post COVID-19, we're going to see where companies are going to try and save costs, in the sense that we're already seeing that as it is that people now want to contract the spaces in which they occupy, look at more conventional ways of working, and see how they can cost. So there's going to be a huge unemployment that's going to happen over the next couple of months. It's already happening as we speak. And because companies are not producing anything, their P&Ls are declining, and that's going to have a severe impact on the property market. Now, as we say that, there's still opportunities in the market. The biggest people who are going to get the hit are the investors who own the grade A buildings, where their rents are over $500 or $600 per square meter. That's going to have an impact, because now everyone is going to realign how they think. So if you think about where companies were in 2016, and they were looking at how their operations were going to be when we had the recession, this is going to be worse, because this is not something that's just going to affect Nigeria. This is something that's affecting us globally. And this is something that's further reduced our liquidity, in the sense that, I mean, we could use the word Nigeria might be broke, because if you look at what Olamide said about the oil prices of crude, as at Sunday, you know, you're talking about 17 cents for the WTI crude in the United States, which anybody who is going to be buying those contracts will have to pay about $37, which went into the negative. So if Nigeria at the moment is struggling to fund its 2020 budget as we speak today, and even giving discounts to their crude, even with the low values, it gives you a sense of worry, is that the biggest spender in the market is struggling to raise cash and to spend, which is the federal government. So, and that's going to have an impact on the commercial industry. But in terms of residential, this is the opportunity where developers can look at more innovative ways of bringing out affordable housing and bringing out more cheaper products. But at the same time, it's still going to have a negative impact on all our balance sheets. It's not going to be business as usual. I know Olamide said, you know, we're looking at about a year. In my view, I'm looking at a minimum of 2 years to get us back to where we are. Because even if the market picks up, you've got the perception of people have to change. And that's going to take much longer. If the government comes out with policies, it takes at least a minimum of 12 months for the policy to trickle down the system. So even if we come out post-19, the government comes out with policies in Q3, Q4, that's going to take you the whole of 2021 for the policy to actually start having an effect in the market. So hypothetically, you're looking at a 2-year minimum for us to even get back to where we want to be. And I think we've got the more gloomy days ahead of us than we anticipated. And this is a problem that is expanding globally. So there will be a decline in returns in the commercial side. On the residential side, that's going to be very subjective, because people will be buying properties for various reasons.
Oh, thank you, Jamil. The funny thing is that we take a position that all of us right now, and the person that shared this with me unfortunately can't join this call today, none so. She takes a position that all of us right now are home. People, whether you're staying at home, you're working from home, you're doing your webinars and everything from home. So it brings the importance of residential real estate during this time. We remain quite bullish about that industry. Why? Because it's a basic need. So it's something that we see going forward. It's still going to be high. It's going to be high in demand. there's going to be opportunities for investors to acquire residential properties. On the affordable side, it depends on what the government does. I think we've all said this over time. We need support from the government. But what I'm hearing everybody say is that there has to be some palliative measures provided by the government. And it's quite interesting. I'm quite glad to have architect Danjira with us today. We would like to turn over to you, and as we focus more into real estate now. My question to you, sir, is that with all this going on, what is the Federal Mortgage Bank of Nigeria doing to alleviate some of these issues that are ongoing? Would like to know from your perspective what the bank can do to its customers, what the bank can do to even new customers. Are you going to continue lending? Is this really affecting the bank? Because I do understand that you have a significant amount of reserves to deploy. What is the Federal Mortgage Bank doing right now, especially products such as your National Housing Fund?
Well, thank you very much. Can you hear me?
Yes, we can, sir.
Okay, so thank you very much. As regards to your question, there are a lot of uncertainty quite well in terms of job and financial insecurity within the system due to the COVID, which we all know. Some of our options, especially when a client could not be able to keep his monthly installment payment of his mortgage, is that we have started informal discussion, myself and the Secretary General of the Nigerian Mortgage Bank Association of Nigeria, which is the umbrella body of mortgage banks. As you quite well know, the NHF mortgage, which is deployed by FMBN through the primary mortgage banks. They are the ones that are intermediary between us and the off-takers. So we have started discussing, and we'll continue the discussion, especially post-COVID, to see how we can leverage and see that amortize some 3 to 6 months more monetization of the interest and even the repayment, so that we can have a free interest extendable up to 1 year. This one we'll discuss with them, and then we'll take it to our board, which will soon meet, because we are supposed to meet just when the lockdown started in Abuja. So immediately after the opening of the lockdown, our board is going to meet and then discuss that. Then we'll escalate it to Mortgage Banker Association of Nigeria for that. So the clients that have started meeting, having this kind of problems, we advise them just to start discussing with the PMBs if there's any challenges they are facing. With regards to whether we can still provide mortgage loans, quite well, it's our core business, which we'll continue to do. And the contributors have an obligation over us to ensure that we get the loans when they apply. We will continue to do that to stimulate the economic activity and create jobs through our products. We have discussed last week with our minister. He invited us to see what are you planning, and these are some of the planning that we have told them. And I wish to tell you that with our current moderate liquidity, I think we'll certainly meet contributors' demands, especially after this COVID-19 epidemic. And as you quite well know, we're envisaging even a downfall or glut in the mortgage market, especially some of the houses, the prices have to fall down, and that will increase affordability to some of our contributors in order to do that. Yeah.
Thank you very much, sir. You know, I'm glad to hear that the bank would be able to meet this liquidity demands, especially from new clients. You know, we've spoken severally in the past, and you know, from our perspective, we see that affordable housing is one of the key pillars to solving any economy. And you rightly agree with this. I just think it's important that the participants and everybody appreciates what's going on, especially with what NHF is able to provide. So again, I'll come back to you, sir, on other questions as we go along, because we're getting a lot more specific questions for NHF. Mr. Zubike, again, discussing regarding the government interventions, and actually, I would also like Architect Danjira to chime in on this. The CBN unveiled a raft of measures that are addressing the economic impact of COVID-19. There's a stimulus package of about 3.5 trillion naira. And so, and this is, sorry, somebody's, can you unmute my phone because there's feedback. From your experience in development finance and with government-backed initiatives, in what ways can we expect these to impact the average homeowner or prospective homeowner?
Thank you, Kola.
Sorry, Chino, you might have to turn up your mic.
Can you hear me better now? Can you hear me better now?
A little bit louder, please.
Okay. Can you hear me better now? Okay. So thank you, Kola. I think thanks for having me on this conference. And I thank the earlier speakers. I think they shed a few lights that quite interesting perspectives to bring to bear when we look at how interventions can happen. I think, you know, Jamil did mention something that is very valid, which is with government intervention, the real question is around the transmission mechanism. How long does it take before we begin to see the impact? The series of solutions that have been provided are actually quite opportunistic, and I think as developers, it's actually timely to look into how best the market can take advantage of the intervention, which is targeted at mortgages and also housing supply. And if the institutional mechanism that is put in place, and this is what kind of structure is being put in place, what is the governance arrangement, and how do you ensure that, you know, it actually gets to those who need it? Assuming all those are well put in place and implementation is executed timely, ideally, you should begin to see some of that impact in stimulating market demand and also supply. However, I think from a practical standpoint, the question now would be, what is our outlook for recovery, right? Because, you know, this pandemic has created sort of social and psychological effect on people. So we're still on a lockdown. We're seeing that these numbers, the cases are increasing. So when do we get out of lockdown? When do we restart the economy? And how do we begin to build confidence again within the market? So understanding how the recovery cycle will take place is also key in really being able to assess the ultimate impact of these interventions. So I would say that, you know, again, to Dr. Shikoya's point, something we need to look into, and I think Architect Dangiwa highlighted this, is around if we understand, and just really, again, it's important for us to take informed decision-making alongside how we see the impact and over what time. And I think taking a view to understand that, you know, over the next 6 to 9 months, for example, we would have a stress in the economy. All of these will be driven by the policy choices that the government make, policy choices in terms of how they're able to restart the economy. Now, let's assume that the policy choices are actually the right policy choices that are driven by ensuring that the right decisions are taken around how the economy is restarted, how vaccines, whether or not we can control well how the vaccines will be, when the vaccines will be found. So that means even after the lockdown, there would be some form of social distancing and some impact on, you know, on businesses over time. Therefore, the question now would be, I mean, to the extent that that this cycle is taking, so the informed decision making is understanding that timeline. And if we say a 6 to 9 month timeline, then we can be strategic about it. Dr. Shika talked about liquidity versus insolvency. I think we need to take a view about how we need to you know, support businesses, support homeowners over a cycle. Because like you rightly said, you know, housing is an essentiality. Therefore, demand is typically inelastic. But right now, what we're dealing with is a psychological, social, and economic stress. And therefore, we need to take into consideration how long it will take for market confidence to build up. And therefore, you know, to a large extent, it creates, obviously, there's the opportunity over time once the market recovers. But between that period, that cycle, I think we need to be very strategic about how we ensure that we preserve value within that cycle. And preserving value is around ensuring that home buyers, and for those home buyers that have stress, that you can restructure and give them sufficient time to recover. For developers and also supply side, that may also be impacted, Now, maintaining that liquidity is critical, and how that is done is also very important. And in doing this, we're able to sustain the market enough for these interventions to be meaningful when they're implemented. So I think it's a good time. I mean, the package is, you know, I think it's actually unprecedented that the CBN is coming up with an intervention for the housing market. I think historically there's always been an advocacy for the CBN to support the housing market. So it's a unique opportunity for the stakeholders in the market to ensure that the mechanism, which is what kind of structure is being put in place to ensure that it's meaningful and it happens. It really depends on the actors in the market to ensure that happens. But to the point is, we need to have a short-term plan, whilst we have a medium-term, because intervention would happen not in the short term, but in the medium term. In the short term is really around ensuring that we can sustain existing, home buyers, existing businesses, provide the necessary liquidity so that at the point where market begins to recover, there is sufficient capacity to scale and take advantage of the opportunity at that point in time.
Thanks again, Chinua. Before I go over to Mrs. Okonjo, Architect Danjura, I just have a quick question for you, and it's something one of the participants just asked. I think it's always it's a recurring question. From our experience at Mixstar, I think this is much improved. But the key question is the processing of NHF applications. I know a lot of people out there believe that it takes years or at least a year to process this. What is your institution doing about rectifying this situation, especially during this difficult time, such that loan applicants can get their loans approved on time? Sorry, so your mic is on mute. I'm sorry.
Yeah. Can you hear me? Can you hear me?
Yes, sir, we can hear you, sir. You're now on mute, sir. Please unmute your mic, sir. We can't hear you, sir.
It's about.
Oh, this is better now, sir. We can hear you now, sir. I think we've lost Architect Danjura there. I think he'll join us. We joined the webinar. So I'll just move over to Mrs. Okonjo. I know I follow you a lot, both on social media and I receive your emails. You have considerable experience in real estate, and the background that you have there, is something that is your view on real estate. What are your thoughts on residential housing post-COVID? Is it still a safe bet? Is it something we should still continue to consider, and why do you think so?
Hi, thank you, caller. I'm just trying to make sure, can you hear me? If you let me know that you can hear me, then I'm fine. Yes, I'll just go right ahead. I can hear
you very well, yes.
Okay, excellent. Thank you, caller. So, I mean, all the speakers have really laid the solid foundation for this conversation. So I'm going to try and sort of move us along in terms of where I see real estate going in the future. Specifically with regards to the question you asked on residential. But before I focus on residential, I just want to share a few thoughts in terms of, the way we're thinking and the way we've always thought about the real estate market, whether locally or globally. When we came into the market in West Africa, 2008, 2007, 2008, we were right in the middle of a recession. And in a sense, since then, we've gone through at least two to three local recessions, depending on who you're asking or who you're speaking to. So in a sense, for us, we've always been focused on the point of view of the marketplace, i.e. the consumers, the users of real estate. And so from that perspective, we're looking and saying that there are always markets within markets, and it's our responsibility as real estate investors, real estate developers, those on the supply side, to look at the current market, the current economy, and the current environment, and realize that, definitely, as someone said earlier, that we're in unusual times. So it is business unusual. And if it's business unusual, I think that one of the key things that we need to do is that we need to rethink. We need to go back to the drawing board. We need to reimagine and, perhaps maybe throw out the old box, because, the way that we've been operating will not suffice for this new economy. This new economy, as Azubike was, saying earlier, we have, customers who are psychologically stressed and stretched, as far as their finances. It's also unique in the sense that it's not just local, but it's also global. So it then means that, as real estate investors, we have to put on our thinking cap and begin to come up with new solutions, and finding ways to, as it were, deal with the market, because there will always be a need for real estate. So it's for us to find out where those needs are and begin to tackle them. What I'd like to do is to use a framework that we are using and that I would suggest to real estate investors in terms of thinking about what the opportunities are and how to rethink what it is that we're doing and could be doing in this season. So I'm going to use what I refer to as the GDP framework. Now, not GDP in the way we typically know it, but I'm just going to go through very quickly. So G in this case would refer to globalization. Now, when I talk about globalization, I'm talking that, from a developer's point of view, from a supply side point of view, if we're looking to stimulate the market, bear in mind, I'm talking now post-COVID. During the times that we're in currently, yes, there are opportunities, but the fact of the matter is that we have to be sensitive to our clients and to the market, and recognize that those pockets of opportunities, while we continue to tap into them, at this particular time, our focus has to be really building client trust, managing the current clients that we have, and making sure that we retain them and that we're sensitive to their needs and ensuring that we support them through these very difficult times, while we ourselves as obviously, investors, suppliers, developers, work with the government to use some of those interventions in a way that sustains our businesses during this time. So back to this concept of globalization, it's really referring to more of expanding our market. Whereas most investors, most developers, and I keep referring to developers and investors by way of, I'm talking suppliers, I'm talking the landlords, but in this particular, the principles I'm sharing, I'm going to be focusing really mainly on the residential market. So in terms of looking at a more of a global market, I believe that the world has never been more global than it is. And I suppose that what's going on currently brings us to that intersection where we see that even though countries are protecting themselves, but there's a sense in which we're all really connected. Obviously, we're using all these digital platforms to connect with people across the world. And, we have nationalities across, various territories and boundaries. And the marketplace also has expanded beyond, our local environment. So with regards to the market, we need to start looking beyond our immediate markets, as it were, because the profile of the clients that we're looking for will need to go beyond what we're currently looking at. So, for example, a few years ago when we had the recession, what we did at Fine & Country was to do what we refer to as taking Nigeria to the world. And, our premise at that time was the fact that we have Nigerians, and this isn't a unique proposition. This is something that clearly has been supported by, the Nigerian diaspora office from the presidency, and most developers took advantage of that platform that we provided a few years ago to tackle or to target Nigerians in diaspora. But what we found was that it wasn't just Nigerians in diaspora. We found that there were investors, and I believe it was Jamil who referred to opportunistic investors. So we need to start rethinking that it's not just owner occupiers, the people who are here right down the road from us in Abuja or Lagos or Ibadan, who are looking to buy these properties, but that people basically are going to be looking all over for where the opportunities. Indeed, every time there's a recession, and even in the last few weeks, we've seen an increase in inquiries for what I've referred to as opportunistic real estate, both locally and internationally. So I feel that currently and post-COVID, we need to expand our view of our marketplace. And that's what I refer to as globalization. The second one I would move very quickly is the D, which I would look at digital platforms or digitalizing, our real estate offerings. And, from that perspective, beyond the technology, I'm basically referring to how can we use digital platforms or the digital framework to provide convenience to our clients. So for example, do clients really need to come to your site? If they're in Hong Kong or in America or in the UK or in Ghana and they want to see your property, do they need to come physically? To what extent are we using technology to fast track these transactions? To what extent are we using technology to enhance the customer experience and the customer engagement? To what extent are we using technology to expand even the market? And certainly in the new world, customers are going to be very mindful of suppliers or developers or investors who are mindful of their time and who are providing a more convenient way of, as it were, engaging with them, especially as a few of the speakers have spoken, that this question of social distancing is something that is here to stay, at least in the foreseeable future. So I believe that as investors, it's important that we begin to think about this new world and how we adapt the way we're doing business to ensure that we're able to still tap into the opportunities. Definitely the opportunities will be fewer, but we can actually expand them if we can use this framework to approach these opportunities. The final one and the third aspect of the framework is the P, and with that, I refer to the product. So which would be, productizing our offerings, as it were. And the way I would approach it and the way we approach it at Fine & Country is to then say, how do we begin to adapt these real estate offerings in a way that suits the new profile that will emerge? In a sense, if we go back to, expanding the customer base, there's a sense in which we're constantly thinking, okay, the immediate investor who wants to buy one property, or the owner-occupier who is looking for a first home or maybe a second home because they're moving up the real estate ladder. But it's important that we begin to think a bit more expansively. So for example, collaborative investors, right? So we're talking pools of investors who come together to invest into a real estate, into a piece of, into a property. How are we, as it were, adapting our properties or our real estate offerings in a way that we can tap into that market? Because as affordability is an issue, it doesn't mean that people will not be interested in real estate. They have to be interested in real estate, because if you think that in Nigeria we have a less than 25% home ownership penetration, which means that close to 80% of Nigerian adults actually rent the properties that they live in. That in itself presents a humongous opportunity in the residential space, and it's investors who will provide those properties. The government is not in a position to provide real estate in terms of residential properties for people to rent. It's private investors that provide and fill that gap. But the question is, we can't think the way we've been thinking in the past. We have to start creating products. And by products, I don't necessarily mean the property itself, but the way the property is presented. If I were to come to you now as an investor and I say, oh, I have a pool of 10 people, has your company thought through the modalities, for example, with working with those types of investors? In future, also, we're going to see a lot of high density properties. We're going to see much smaller properties. So the product itself needs to start being also re-engineered to meet the new marketplace that we're going to see. What about the profiles as far as, we're talking millennials, for example? What about, the aged, as it were? So the new economy, we need to start rethinking it and start looking for the opportunities that exist there, so that we're not camped out, in essentially the same old things and the same old products. Most of the questions we get at Fine & Country West Africa is usually around, lots of properties that are hanging around on the island, Ikoyi, Victoria Island, they're empty. The reason they're empty is because most people, most investors, and most consultants or advisors have not gotten to the place where they've become creative, they've become innovative, and they've started rethinking this box. Those empty buildings have a use, and it's only the investors who are able to apply this creative thinking in this new economy that will see those buildings actually put to good use. I imagine that we'll have an opportunity to talk about some other aspects, but I'd like to stop there just to make sure that I'm not, going on for too long. So those are the 3 points that I'd like to really mention. That framework of the GDP, which we use, across, for other businesses and business consulting. However, I'm applying it to real estate, and I'm saying that that framework basically comes down to the bottom line, which is that we have to be creative and we have to, rethink the way that we do business. There are new opportunities and we need to tap into those new opportunities. The residential sector continues, to be an incredible sector for real investors to actually invest. You know what, I just want to say very quickly, there is a guide that, we presented or we shared some time ago, and I'm happy to share that with you, Kola, if you'd like to share it with your clients.
Send it to us and we can share it, the link with
yes, it's an astute investors guide that we put together during the last recession, and these principles are really timeless real estate investment principles. But if I just mention the first one, it says be recession proof. And it was actually taken from a lot of the principles that Warren Buffett and some of the top investors, both in real estate and in other asset classes. Be recession proof, befriend the market. Look at market fluctuations as your friend rather than your enemy. Profit from folly rather than participate in it. So instead of worrying about the market conditions, we have to look for new opportunities to create value for our portfolio and to profit while others are essentially frozen to inaction, making the wrong moves and all of that. So really, market conditions are largely irrelevant if your investment strategy is right. We have to understand the market, know what the cycles represent, understand the opportunity in the particular target real estate segment that you're operating. Even in the commercial, there are opportunistic investors. In the last few weeks, we've received some inquiries that really appear to be very strange. But because of what we know that there are always opportunities, or rather markets within the market. I'll stop there, Kola. Thank you very much.
Thank you. Thank you very much, Udo. I always enjoy listening to you and your perspectives on real estate. I'm going to come back to you again, but
sure.
We have the opportunity to really tap Architect Danjo, and we lost him. I think he's back now. Architect Danjo, are you can hear us?
Yes, I can hear you very well.
All right.
Go ahead.
Okay, so what I had asked then, and this is, and just for everyone to know, we're getting these questions from the over 370 participants on this conference call. What I had asked then was, someone was concerned about the length of time to process NHF applications. We're talking about affordable housing here. People believe that NHF applications take, on the average, about a year. There's that perception in the market that it takes about a year to process. Is this the case? And what are you doing about this?
Okay, thank you very much. Quite well, it's no more the case now, because we have to had a retreat with the mortgage budget from the mortgage bankers, primary mortgage banks. They are the ones that customers approach, and they package the loan, then forward it to FMBN. So sometimes it delays at the PMBs, and people assume that it is the FMBN that has delayed these loans. So that's why there has to be a joint retreat between the Mortgage Banker Association, the Real Estate Developer Association, and the Federal Mortgage Bank to ensure how do we reduce the turnaround time of our mortgages. We allocated time to every loan to ensure that a loan doesn't take more than 3 months for it to be consummated and then paid for. Sometimes you'll find that currently we have approved a loan within last year. We have approved a loans of over 120 mortgage loans, but out of it, only 70 million mortgages have been accessed. The reason is that some of the condition precedents to draw down by the PMBs, they are the ones to meet it, they could not meet those conditions. It's a problem between them and the developers in terms of perfection of documents and other things. So we have to create another option, that is the Internal Record Office, IRO, whereby we streamline these things and ensure that the turnaround time is quite reduced. Quite well now that most of the mortgages that we create, they are within the 3 months maximum duration. Yeah.
So are there any specific new measures that the bank is taking to widen the pool of applicants to this fund? Are there new? I know since you've taken over the running of that institution a couple of years ago, we've seen an increased number of mortgages issued. Or are there new measures that you're taking as an institution to increase the number of qualified applicants for this? I'm sorry, sir, your mic is on mute. I'm sorry, sir, your mic is still on mute, sir.
Can you hear me
It's
now?
okay now. It's okay now, yes, sir.
All right.
I'm sorry, sir, it's gone on mute again. It's okay now. Yes, it's fine now, sir.
All right. Yes, we have to reach out to the informal sector that constitute over 80% of the working population of the country to ensure that they join the NHF and benefit creation by have to create other product for those informal sector to benefit from, which is the cooperative society housing development loan, which we have just created. It's a way of create and get a construction loan to build houses for their membership and then let create mortgages under the NHF cooperative loans for them. We also have to, we have reached out to some of the states that have not been contributing. They have now come back to contribute. And the other thing is the option of, we have to explore the opportunity of diaspora mortgages and offshore investment device in order to, even before the COVID started, we have reached out to some of these diasporas. We have been to the UK, we have been to Russia to discuss with these diaspora organizations to see how they can benefit from the NHF mortgage loan, which is to do. Earlier on, you find that they send their money to their relatives to build houses for them. They ended up sending the pictures of another site, not their own. So when we came back, we also invited the diaspora, Nigerian Diaspora Commission DG, who is Ms. Adebike Dabri. We've discussed with her and she has agreed to that, and we are giving her a framework on which we can now access the diaspora mortgages. We are developing that paper for our board approval. So these are some of the issues that we are doing to ensure that wider pool of people now are accommodated into the NHF.
Thank you, sir. It's quite interesting that you note that you are, targeting the Nigerians in diaspora. Over the past couple of years, we as Mixter, we've done several trips across the globe, and a significant amount of Nigerians, they want properties, but it's obviously because of their income. They have more stable income than those of us in Nigeria do have. So they always want to match that to mortgages. And it's something that I would actually look forward to. We've spoken to the Diaspora Commissioner at DG about this too. And she mentioned, she reassured us that there was something coming up in the works. So it's something that I know ourselves and our investors, our clients would look forward to. But one more question to you, sir. Is there anything FMBN is doing from a technology point of view to streamline these processes of loan applications? From our experience, we started a project, as you know, it's called Mixter Flex earlier this year. We saw a significant number of properties, and a lot of these applicants are going through the process. But what we do find is that there's a disconnect between the PMBs and NHF or the bank itself. So is there any technology that you are, that you're spearheading for the PMBs to come along with, or the PMIs to come along with, to consider?
Well, apart from the bioman and the Redan, we have started developing technologies through our core banking applications, which we are about to procure. It's already at the Fed awaiting approval, and once it is approved, it will go into our already existing Oracle 12C application. That will be going to lead us into even online applications by customers, even online, and then they get the applications approved, and then that will take, it's going to quite well reduce the turnaround time by at least 70%. So instead of the 3 months that we used to have, it might likely come up to just 30 days within which we get approval of mortgage loans. We're also considering joining mortgages as long as they are legal couples. Like a couple can come and then get a mortgage. As long as they are couples, they can be given this mortgage to move on.
Thank you very much, sir. One last question for you, sir. And again, it's part of the questions that we're seeing from our participants here. They have asked that what is the strategic intent of the Federal Mortgage Bank of Nigeria vis-a-vis endeavors of other MDAs? Given the Federal Mortgage Bank has been longer in existence, is there any collaboration between these different, is there any reason why this collaboration seems weak between the Federal Mortgage Bank and other MDAs? And I think to allude to what the participant is asking, I think what we see from our perspective is the Federal Mortgage Bank has its own set of initiatives. Then you have different MDAs with different initiatives. At the end of the day, we're all trying to solve this housing problem, right? So why is there so much of a disconnect between all these different agencies?
Quite well, we have observed that disconnect between some of the agencies. You'll find that sometimes government create organizations with duplicative roles. So with that duplication roles, you'll find that some organizations will be doing a role that another organization has already been doing. So if the government could not be able to come and then streamline us and ensure that the two organizations are working together, things are going to get very difficult for that. Just like the case of the Family Homes Fund has just been created, it is there to provide similar opportunities that we are giving, like the construction finance, they do mortgage finance, and those kind of things. So the need, you'll find that if not because of us, the two chief executives that decided to come and sit down and see how they can collaborate within themselves and then improve their own services by themselves. The government has never come forward to ensure that the two of us work together in two. But we are making our own efforts to see that Federal Housing Authority that is meant to produce houses, they now approach us to create mortgages for the houses they have built. Family Homes Fund that have given construction loans to those institutions, they are now coming forward to the FMBN to give the affordable mortgage to the contributors to the NHF that showed interest in that. So as long as the government has not come forward to do that, the two institutions must ensure that they now streamline their own activities to ensure that for the benefit of the nation. Thank you.
Thank you very much, sir. I think it's quite instructive that you mentioned the Family Homes Fund. We worked a lot with the group led by Mr. Adewale. And what we found was that, yes, there was just a lot of disconnect between the NHF and the Family Homes Fund. But I think one key thing, and I don't know if you would agree with me, is the fact that your fund is structured and it's funded, right? Do you agree with that? That it's a key distinguishing factor in terms of how to execute on how to offer affordable houses or affordable financing for houses across the market?
Well, as you quite know, the FMBN NHF is not funded by government. It's a contribution, it's a full of contribution by the contributors into the fund. And as long as it's their own contribution, mortgages has to be given to them as concessionary interest rate over a long period of time. That is the main essence and the purpose of even creating that the scheme in itself. So a scheme is created to leverage or to assist the low and medium income earners who are contributors into the NHF in order for them to promote home ownership through the affordable mortgages. So that is the key distinguishing factor in it. Other organizations will find that they are funded by government, but NHF is not funded by government, but it's full of contributions in order to create a full of funds for the benefit of the low and medium income owners who are the contributors to the fund.
I think you still have to answer a question, and I think we're seeing a lot of questions from participants regarding when exactly this diaspora program would come into the market. I think people are very interested in that. But before you do, sir, I'll just go over quickly to Chinua. Chinua, Mr. Azubuike, I would like for you to speak more about the different cycles of real estate. You've worked with a lot of government initiatives to resolve this affordable housing problems. From your perspective, how do you see what interventions what are the interventions that can be beneficial to the real estate sector right now? And again, I would like for you to also speak from an affordable housing perspective, keeping in mind that we also have a lot of retail clients here that are thinking of buying homes, and they're trying to make their decisions whether they should acquire their homes or their properties today. Where are we in the market? Is it a good time? Please.
Thank you, Paula. Okay.
Sorry, Mr. Azubike, your mic once again. I think you have to increase it or move closer to your screen.
Okay. Can you hear me better now?
Yes, sir.
Okay. So affordability is it's a moving target, a three-dimensional policy issue, which is basically driven by the household income of the borrower, the house price, and the mortgage interest rate. So these things tend to impact on how you define affordability. And over time, I mean, government has initiated several interventions to attempt to address one or two or three of these components. And typically, they either look at the accessibility to long-term financing, which was why the Nigerian Mortgage Refinance Company was established to promote access to long-term mortgage finance. Another was to also look at the interest rate constraint, which is what the NHF is seeking to achieve, provide lower interest rate mortgages to address the interest rate challenge. Obviously, the one you can't really tamper with is driven by really the economic circumstances of the country, and general welfare is the household income, and that is really driven by the growth in the economy. But also, I think through these mechanisms, attempts have been made to reduce, improve access to home ownership, reduce the cost of capital, and increase access to long-term finance. And I think still till today we still bandy this housing deficit of 17 million plus, which suggests that these interventions are working, but maybe there's one or two areas that the market needs to look more intently into. And I think to Architect Dangiwa's point, all these institutions can work together. The market the gap is big enough that you can have multi interventions, but there has to be a coordination amongst these institutions, how they leverage off their respective strengths, and then they mitigate their respective weaknesses, because not two institutions are not so perfect in certain markets. So how do we see intervention happening in a sustainable way, or in a very impactful way? I think, when we look at some of the constraints still facing the market, and I think for developers, one of your challenges is, access to how do you access the supply side is affected by the infrastructure, the cost of the infrastructure, and also, titling and registration issues. And these are issues that, cut across it, and they require a certain type of policy intervention to help reduce that cost. And this continues to impact on the supply side, the cost of the supply side as well. So again, how holistic can we look at the market? And what are some of the gaps we've seen that we think that there's some opportunity for institutional capital to actually play a role? And so to your point, these interventions are in place. And if you look at cycles, you talked about real estate cycles. I think Dr. Okonjo talked about the fact that, he also reemphasizes the point that home ownership is an essentiality, right? So which means people always need to have homes. And so if you recognize that it's an essential asset, which means, that demand will always be somehow inelastic, irrespective. It could just basically shift between classes depending on market cycles, but there will always be a demand. And so for institutional capital, I would say that, for those investors that hold long-term local currency finance and capital that can invest for the long term, it is again an opportunity to understand how best to take informed decisions, looking at where the market is today. And so from our perspective at InfraCredit, what we've attempted to do is to engage with for affordable housing developers to understand some of the challenges facing the market. A lot of what we see is around the liquidity and the accessibility of the financing. How accessible is it? How liquid is it? And how can it be made affordable? And I think a lot of what we're looking at currently is how we can bring actors together to work in a coordinated way, because we also feel that a bit of silo approach to solving the problem makes it more difficult, and you have several actors trying to achieve the same objective in different ways. And institutional capital would have a very significant role to play in helping to bridge some of these market gaps. Why? Because long-term institutional capital, especially intelligent capital, can come in to bridge market gaps with a good understanding of the market cycles. So, and it brings me to where we are now, which is we're talking about recovery. We're talking about whether it's a recession or a depression may happen at some point in time. But the reality is that, if you look historically at cycles, even though we know that this is an unprecedented situation and a lot of the recovery will be driven by policy actions, but certainly over time, we know that there's still going to be stepped up demand. And therefore, I would be looking at interventions that can help to bridge liquidity and provide accessibility for home buyers that are still willing and able to pay, take advantage of market prices for homes today, and be able to step up at the point in time where market recovers. And I think being able to look at mechanisms where we can leverage off those providers of capital that have that concessional finance. Take advantage of developers that are able to produce or have already land, stock of homes that are affordable and accessible, and create a funding solution that allows home buyers to be able to provide access that liquidity on a timely basis, that also is affordable and can give them that headroom that they require over time, to be able to access market and create, I would say, a market. And I think I like Okonjo's point about, Dr. Udo's point about a market within a market. We do have what we call a non-consumption market. And sometimes it depends on how you define that market. The existing markets that require a unique solution. And if we take the population in the country and the demand for housing, I think there is that market that can be created within some level of efficiency. And therefore, I think for us, we feel that there is an opportunity. What we're particularly interested in working with partners around is how to evolve through the current market cycle and the dynamics. We need to create the right type of financial solution that can enable us sort of navigate through current market challenges and then sustain growth when growth comes, because growth will come. And it's a question of, who's that intelligent investor taking a view as to when growth would come, and how are you able to create instruments that can enable markets to evolve through this cycle and take advantage of that growth. And so I think, so I think, we do have a lot of the solutions. The local pension funds obviously have a very key role that they can play, because again, for RSA holders, there is a need to ensure that we can sustain those who are able and want to own homes, and those who do have that may have challenges with jobs today, but will get jobs tomorrow. And how do we ensure that we can create solutions that can bridge market gaps and sustain growth? Because like you said, there are cycles, but the real estate market, the big challenge that has always been a common thread across is that access to long-term affordable liquidity. But there is still an upside, and there's an upside that the developers will tell us that is why they're still in that business. There's an upside why Dr. Okonjo is so bullish about real estate. And I think for informed investors to understand where the upside is, and be able to create solutions that can create access, provide access for those who need it, and then participate in the upside, creating a more liquidity for a market, more efficiency and scale for that market. So I think working together, there are solutions that can actually complement, especially the interventions that the government brings in place. At the point the intervention is ready, there is the instrument to be able to absorb that intervention. So I think I'll highlight the fact of coordination. It's extremely important, especially for actors that also need each other to be able to be more efficient. Creating the right institutional structure would enable private sector to position themselves with the right type of instrument to absorb interventions when they come. And that creates discipline across the market. It creates standards across players within the market. And when you have that sort of market discipline and standards, then capital comes in bounds and the market can scale. And we've seen this happen in other markets, right? And we're not, it's happened in other markets, and there's no reason why we can't see the same kind of, evolution happening here. So I think for us, the question is, where is the opportunity today? Because again, what we hear is a tale of, there's going to be challenges. Certainly there will be challenges, but there will be a recovery, and the demand is going to come back because there's always going to be demand for homes. Question is, how do we work together to ensure that we can sustain constraints today and prepare for the opportunity tomorrow? And I think there are solutions that we can look at, because historically we have seen this happen successfully in other markets. The only caveat is, policy decisions on how the government manages, how the economy is going to be restarted is very critical to ultimately, whatever assumptions we make about growth in the future.
Thank you, Chinua. I think what I hear you say is that for this cycle, or for the recovery to be beneficial to our investors, to the retail investors, institutional investors, and the likes, government institutions like the NHF, Federal Mortgage Bank, FHF, the central bank, and other institutions have to work together. We all have to coordinate and attack this issue together. I couldn't agree more with you that demand for housing is always going to be there. People need places to live. When you look at the size of, I always take Lagos as an example. When you look at the size of the market compared to, I believe the stats is that the Lagos, the amount of 60% of the economic spend of the country, at least 60% occurs in Lagos, right? But only Lagos has less than 1% of the landmass of the country. So that tells you where the opportunity really lies, right? And when we all look at Lekki and BI and all the things that are going on further down Lekki, the refineries that are coming up, it tells you that demand is strong. It's just what we all do as institutions to help foster, to help finance, or to help people get onto that ladder. I'm going to start wrapping this up. We have a little bit over 15 minutes to go through the rest of the session. So I'm just going to go 2 questions to you, sir, Architect Dangiwa, before I ask everybody a couple of questions. You mentioned the informal sector. And I do know that you also mentioned that your fund is funded by those that are contributing. How would the informal sector, how are you going to bring on board this large informal sector onto the fund and start lending to them? I've also heard a lot of PMIs speak to the fact that they don't really focus on the informal sector. So I find it interesting that you, as the market leader, you want to tackle that challenge. We all know that if we can bring the informal sector onto this structured ability to get structured finance, it changes the game. It helps with affordability. How are you going to manage that risk of bringing the informal sector on board?
Well, thank you very much. The issue is that when we realize that currently we are dealing with the formal sector, we realize that that formal sector is constitute only 20% of the total working population in the country. So the informal sector constitutes 80% of it. It's a huge market that we must have to see that we invest into. And the only way to do that is let's devise some of the products that will attract them into it. We have products that they can, product options for either to buy or to build their own houses through individual construction loan, or through the cooperative loans whereby estate developers are invited by the cooperative societies to approach the bank to give them a loan to build the estate, and then we create mortgages for their members. We also have the rent to own, where some of our funded estate that we already have, people, even in the informal sector, can key into it and then enter as tenants while paying their monthly or annual rental income. The house become their own. We have the option also renovation loans. So these product options are what we are now putting on board to see that we attract them. And the risk factor which you mentioned, basically is that most of the self-employed, you find that they earn more than even the employed people. And most of them, as long as you key into, you bank your money into banks, you must have a BVN. So we are discussing with the ADD, automatic debit transfer, whereby the NIPS are ready. We have started discussing with NIPS to see that as long as you get our loans and you have a bank account, at the end of the month, whether you pay or you don't pay, it goes into a BVN and collect our refund, our payment, and then back into our accounts, into our own accounts. So this is a major thing that we have to ensure that for anybody that has to key in, a self-employed and informal sector person, then you must have an account with any of the banks in the country. And once you have an account, you must have a BVN. That is the major consideration we made, and it's a arithmetical which we are now trying to adopt currently.
Thank you, sir. So I hear that clearly, and I'm glad to hear that. I'm sure a lot of people are also excited because, you know, like we all know, there's a huge informal sector in Nigeria, and a lot of people have their businesses, especially when you look at a lot of real estate agencies out there, real estate professionals. When we sell our products as Big Star, for example, it's always hard to understand that most of these guys, because of their commission-based income or their businesses, they're not able to qualify for NHF. So we really look forward to this coming upstream. When do you see the diaspora mortgages coming on stream? I don't want to put any pressure on you or anything, but if you can give any guidelines in terms of timelines that this will come on stream.
Well, the paper has already been developed by the management, the bank, now awaiting our board approval. If not because of the COVID lockdown, the board would have met and then approved that diaspora mortgages for us. And then once it is approved, we now forward it to our minister, who will now put the finishing touches and then to go into the market. So I'm hoping within the year, this diaspora mortgage is going to take off. And as long as the diaspora commission are on our heads, calling us most of the time to see that they are very much interested in these diaspora mortgages, we are collaborating with them to ensure that this diaspora mortgages took off within the year. So I show you that.
All right, thank you, sir. That's I think that's very clear. I think we're all going to be looking forward to a lot of activities from your bank. I think I'm quite excited to hear you mention things like the cooperative loans, the rent-to-own schemes. These are opportunities that for the retailers, for the retail investors here, and this is why we bring this type of sessions to everybody. You know, information might not be out there, but you've heard it. There are these opportunities out there to get mortgages, either as a group. Very soon, we'll be looking at mortgages for diaspora, the Nigerians in diaspora and the informal sector. So I think this is quite good news. Just to take this down and to start shutting down the session so that we can release our panelists in one quick answer, and I'm asking everybody this same question. This is for all the panelists. Do you see a market, a price crash in real estate in 2020? Dr. Oshikoya, can you please go first?
But I think those who are the regulators, the operators have spoken a lot about the real estate aspect of this. But nevertheless, if you look what happened in 2008, when you will have the global financial crisis, the Nigerian stock market has not recovered where it was as of now. It has not recovered. And real estate actually grew by almost 9% between 2010 and 2015, while the equity market was actually completely stagnated or even went down. Of course, immediately after the 2015, in 2018, real estate also went down in terms of its growth. But I'm very optimistic that real estate will remain a viable investment option, and therefore, even if the price is going to go down, it will not be the same as, say, for example, the equity market, which stagnated for such a long time. Because real estate provide you a home, provide you a source of stable income. Your house will always be there, even if the stock market crash. So as a result, even if the market prices even if the real estate market prices should go down, I do not think it will stay low for such a long time relative to other investment vehicles such as equities.
All right, I think that's fair. I think, Mrs. Okonjo, can you please just share your perspective, keeping in mind the time that we have left? Would there be a price reduction? Price is going to crash in this market in this year?
Absolutely. You know, I mean, I avoid using words like crash and those types of very dramatic language, because we're very keen on always trying to inspire confidence with accurate information. So there will always be adjustments, you know, to reflect the mood of the market, to reflect the psychology of the people who are in the market. So prices will definitely adjust, but, you know, therein lies the opportunities. People who are trying to get into the real estate ladder or move up it will take advantage of the opportunities that exist at this time. In addition, we have to remember that there's a devaluation of currency. So for those who are in cash positions, who their timelines as far as investment, obviously, you know, if you have money that's for short-term needs and expenses, that's not money you're going to put in real estate, you know. But if you have money that you've maybe put in savings, it's definitely being devalued currently. You know, I don't like to get into the battle between equities and real estate, equities, cash, or real estate, but certainly real estate benefits from two key things. One, the inflation. It's a very good asset class to, you know, hedge against inflation and definitely devaluation for those who have long-term funds or long-term interests, you know, as, you know, the earlier speaker was saying, if you're looking to buy property that you have use for, or that is a long-term asset, you know, and you have uses for it, whether it's commercial, it's residential, or whatever it is, then definitely I do believe that the opportunity is there. But to answer your question directly, yes, there will be an adjustment and a correction, and it will continue for a long time. Bearing in mind that the time frame, I just want to refer back to some of the conversations to just, you know, maybe because we have the Federal Mortgage Bank MD here, you know, things like tax benefits for first-time home buyers, you know, things like, you know, some sort of tax break. So I think we can take that conversation offline. Beyond this, you know, Kola, I'll be in touch with you, because I think that, you know, stakeholders in this industry, there are things that we can begin to look at to actually stimulate the market, you know, post COVID, to ensure that, you know, this very, you know, housing, which is important. We're not talking luxury real estate here. We're talking, you know, affordable housing and housing for first-time home buyers, and for people who are providing housing for people who do not have, you know, homes to live in. So yes, market correction, yes, you know, lower prices, and yes, big opportunities in there. Thank you.
Thank you very much, Mrs. Okonjo. You're right, we shouldn't use dramatic words like a crash. We would use more price correction. I think that's what a lot of us do nowadays. But I think it's going to be limited to different markets. You might see price correction in the premium side of it. For as long as institutions, like if the government does do what they execute on these plans and make affordable mortgages available to clients, to buyers, I think that would help stimulate demand. And because really, for us property developers, we've already cut our prices to like a bare minimum that you wonder why you're actually still in this business, right? But again, that's where we also recognize that the market really is. When you look at the income profile of the country, a good number of people are within that bottom to middle part of the pyramid. So we have to continue to focus there. Mr. Zubike, the same question to you. Do you have any contrary views to this general answer that we have?
General answer that.
I'm sorry, do you see a price correction going on in the market this year? for the real estate market?
So, I mean, what would happen is we're seeing, we will see supply outstrip demand, right? That is going to happen. And the question is how the suppliers of real estate will react to that, mismatch in the short to medium term, because demand will ultimately pick up. But in the short to medium term, because of the social and psychological impact that this pandemic is causing, it's really going to impact on consumer behavior, consumer preferences over the medium term. So the average person is probably thinking of job security, savings, healthcare, and that will be on people's mind for the near term. But as market evolves, we expect to begin to see stabilization and the natural demands that people would want to own homes. So there would be that gap, and I think it's just being able to to sustain through that cycle, which could be again 6 months, it could be 9 months. Again, policy decisions will drive this. But for developers, it's really to have a strategy that enables you to go through this cycle, because there will be demand over time. So I just see this as a cycle. But again, the always caveat I put is about how the government manages the recovery ultimately. But again, I try to say there is a class of borrowers. It's just to understand your product design and for your market. And there are still those who can access homes. And I think there are solutions to enable those who still demand for homes, even during this cycle, to access those homes. So that's the sort of strategy that I imagine that, out of the box thinking that developers need to put in place to navigate it. But the market will ultimately is a resilient market. It is a resilient market, and it will pick up. So we shouldn't assume that, especially for those developers that have product designs that are targeted at unique markets, right? It's a resilient market.
Thank you very much. I think that's quite clear. You said supply will outstrip demand. Architect Dangiwa, just the final question to you. Do you see a price correction in the real estate industry this year? I'm sorry, sir. Your mic, your
okay.
Yes,
you hear me? Okay.
Yes, sir.
I'm foreseeing that with the post-COVID, there will be a conversion of the housing from social problem into socio-economic opportunity for the economic development of the nation, because it is one of the highest job-creating sectors of the economy in terms of as a catalyst for both manufacturing and financial services growth in terms of that's what we mean. So it also helps easily adopt the new technologies in construction, finance, and other stages of evolution. You find that most of the developed economies build their own economic strategy around housing as a major pillar. Nigeria should also key into that. With the COVID, I'm foreseeing that cost of housing may reduce due to the glut and due to the developers, they want to sell their own products. And being that housing or real estate is a more viable investment opportunity and safer than investing in stocks. So people may likely convert their own money instead of investing in stocks that has already crashed into the real estate. So more people are coming to invest into the real estate. You'll find that definitely there's going to be glut because people will not, no more people who can buy. And then at the same time, the prices has to come down for that to be. So it's, I can see there's a great opportunity for that. That's why I want to see that these public institutions, the government has to, or the public has to leverage on this public institution like the FNBM, FHA, Family Homes Fund, to take on because they take more risk than the private sector that they cannot take. With that, you can find that we develop more of market than the other sector, that is the private sector. So we should do the same thing here. With the Nigerian population increasing, and think that with the glut that is coming, houses will have to come down, and then people will now own their own houses. Thank you very much.
Thank you very much, sir. I think it's quite warming to hear that you say that the public institutions are going to take on more risk than like the private institutions in solving these housing problems. What we do, we look at it at Mixter that the way we see housing at Mixter is that housing is like the bedrock of the economy. Housing presents an opportunity for an individual to build their own personal balance sheet, right? It's for most people, it's the most expensive expenditure they would ever incur in their lifetime. So the more people that have houses, the more stronger the personal balance sheets of all these individuals of the country, which more or less translates to a better economy. Again, I would just like to, we're coming to an end. We've come to an end of this session. We really appreciate the time devoted to this. I know it's very difficult, and it's very difficult for you to devote 2 hours of your time, considering all the amount of work that we all have to do right now. But we thank you very much for taking the time to be with us today. We really appreciate your contributions. And for all the other participants that have come into the session today, we thank you for taking the time to spend these 2 hours with us. And from what I'm seeing here today, I think we might have to have another session like this, but because it just seems like the time is not enough. But again, thank you very much, everyone. Again, like we all say, stay safe and please stay at home. Thank you.
Thank you.
Thank you.
Jamil, thank you very much.
Thank you very much.
So very much, everybody.
Thank you.
All right, Tess.
Yes.
Okay, thank you, Dr. Shikoya.
Thank
you so much. It was a really informative session. We've had feedback from people even now.
Thank you
and
very
it was
much.
really good.
Yes, thank you.
Okay.